Every nation on this planet carries a burden of debt. The United States carries an obligation of $38 trillion, while Japan's is $9 trillion. Collectively, the entire world owes $315 trillion, a sum that is triple the magnitude of the global economy. Yet here lies a peculiar paradox that ought to instill profound concern. If every entity owes money, to whom is this money actually owed? The answer may defy common assumptions. Upon tracing the lineage of creditors and meticulously charting the holders of this debt, a disquieting truth emerges. The world owes money not to any specific external party, but rather to itself. However, this intricate arrangement was deliberately orchestrated by 4 financiers across 3 distinct centuries. They devised a framework where the debt can never truly be extinguished, obligating governments to perpetual borrowing, ensuring an unending stream of interest payments, and thereby enriching those who architected this seemingly inescapable predicament with every transaction, every financial upheaval, and every government rescue. This is not a speculative theory. It is a matter of recorded history. The meetings transpired, the agreements are preserved, and the mechanisms are publicly documented. Once you comprehend the design of this structure, you will understand why $38 trillion in debt is not an issue to be resolved, but rather a system functioning precisely as intended. Allow me to introduce the 4 masterminds behind this grand design. The pivotal moments when this debt entanglement was ingeniously engineered, and the reasons why every government worldwide is now ensnared within its confines with no apparent recourse. Prior to the year 1694, monarchs traditionally secured funds through conventional means. They would approach merchants or nobility, pledging repayment with accrued interest. Should they falter in their obligations, they would declare default, resulting in losses for the lenders and a need for the sovereign to seek funds elsewhere. This process, while presenting risk to financiers and potential embarrassment to rulers, remained localized. Debt was a finite obligation, either settled or defaulted, bringing a conclusion to the matter. William Pattison, a Scottish merchant and ambitious financier who had previously experienced multiple unsuccessful ventures in wealth accumulation, fundamentally altered this landscape in 1691 with a concept that would reshape societal structures. England, then engaged in conflict with France, urgently required financial resources for King William III. The royal treasury was depleted, and tax revenues were insufficient to cover wartime expenditures. Existing lenders were hesitant to extend further credit due to prior defaults by England. Paterson presented the king with a novel proposition. He would assemble a consortium of wealthy merchants willing to extend a loan of £1.2 million to the government. This sum, equivalent to approximately £300 million in contemporary value, was substantial. The revolutionary aspect of this proposal lay in its structure. The principal sum would never be repaid. Instead, the government would commit to perpetual annual interest payments at a rate of 8%. To manage this complex arrangement, Pattison advocated for the establishment of a new entity, the Bank of England. The operational framework was groundbreaking. The merchant lenders would deposit their gold with the Bank of England, which would then lend these funds to the government. Annually, the government would remit interest payments derived from its tax revenue to the bank, which in turn would distribute these payments to the merchant lenders. Crucially, the government was not obligated to reimburse the original loan amount. This loan was designed to be permanent. The merchant's acceptance of this arrangement was secured by the guarantee of interest payments, sanctioned by Parliament and underpinned by the government's taxing authority. As long as England possessed the capacity to tax its populace, the interest would continue to flow. Furthermore, the banknotes issued to the lenders in exchange for their gold were designed to be negotiable, functioning as a highly desirable form of currency, even superior to traditional money due to their interest-bearing nature. Parliament formally endorsed Pattison's initiative in 1694, chartering the Bank of England. The merchants contributed their gold, the government secured its wartime financing, and for the first time in history, national debt transformed from a temporary liability into an enduring feature of the financial system. The brilliance of this system, from the perspective of the bankers, was that the government committed to an annual interest payment of £96,000 on the £1.2 million loan, a perpetual annuity. As long as England persisted and maintained its taxing power, this income stream was assured. Should the merchants wish to reclaim their gold, they could transfer their banknotes to another party. The debt itself was transferable, but fundamentally irredeemable. Paterson's true ingenuity, however, lay in the subsequent development. The Bank of England was granted the authority to issue banknotes backed by the government's debt. This permitted the creation of paper money up to the value of the loan, effectively generating currency from debt. The government's promissory note evolved into legal tender, and the more the government borrowed, the greater the potential for money creation. This became the established model. A government borrows, never repays the principal, pays perpetual interest, and the debt itself becomes the very medium of exchange. This system proved exceptionally advantageous for bankers while imposing a significant burden on taxpayers who were compelled to service interest on a debt that would never cease to exist. Within half a century, virtually every major European power adopted this model. France established the Banque Générale, while the Netherlands, already possessing advanced banking infrastructure, formalized government debt issuance. By 1790, the newly formed United States embraced the same system, with Alexander Hamilton meticulously structuring America's financial architecture on the principles of the Bank of England, incorporating permanent debt, interest funded by taxation, and bonds treated as currency. Though Paterson passed away in 1719 without amassing substantial personal wealth, despite his instrumental role in founding the Bank of England, the system he conceived endures 331 years later. The Bank of England continues to operate, and British government debt, though continually refinanced, rolled over, and expanded, has never been fully extinguished. The debt trap was thus established in 1694, and subsequent governments have willingly succumbed to its allure. By the early 1800s, European governments had fully embraced the practice of accumulating debt, utilizing it for wars, infrastructure projects, and operational expenses. However, a formalized market for this debt was yet to emerge. Each loan was negotiated individually, interest rates fluctuated significantly, and participation was largely confined to the most affluent merchants. Nathan Rothschild revolutionized this landscape by industrializing sovereign debt. The Rothschild family, initially engaged in currency exchange and trading in Frankfurt, expanded its influence by the year 1800, with the 5 Rothschild brothers establishing banking houses in 5 key European capitals: London, Paris, Frankfurt, Vienna, and Naples. This interconnected network was unprecedented, enabling them to facilitate capital transfers across borders with unmatched speed and efficiency, thereby dominating the issuance of sovereign debt. Nathan Rothschild, based in London, proved to be the strategic architect of this dominion. During the Napoleonic Wars, Nathan arranged substantial loans for Britain, but his innovation lay in the structuring of these transactions. Rather than directly lending to the government, he procured government bonds at a discounted rate and subsequently marketed them to investors at a profit, effectively creating a secondary market. Governments requiring immediate capital found Rothschild a readily available source. He then disseminated these bonds to entities such as pension funds, insurance companies, and affluent individuals. The government received its funds swiftly. Rothschild profited from the price differential, and investors acquired a transferable financial asset. The situation darkened considerably as Rothschild not only facilitated government financing, but also strategically positioned himself to ensure that governments had no alternative but to engage his services. At the Battle of Waterloo in 1815, Nathan Rothschild famously received intelligence of Napoleon's defeat before any other individual in London, owing to the superior speed of his courier network compared to official channels. He leveraged this information to manipulate the bond market. Initially, he sold British bonds, signaling a potential British loss, which caused bond prices to plummet. This triggered widespread panic among other investors, leading them to liquidate their holdings. Subsequently, at the nadir of these prices, Rothschild amassed significant quantities of bonds at exceptionally low valuations. When news of the British victory arrived the following day, bond prices surged, resulting in millions of pounds in profit for Rothschild, not through illicit insider trading as it might be defined today, but through his masterful control of information and precise market timing. This established the enduring Rothschild model: control the flow of information, control the issuance of debt, and control the market itself. By 1820, the Rothschilds held a commanding position in European sovereign debt markets. Any government requiring financing would invariably turn to the Rothschilds, who controlled the essential network of investors and dictated the terms of engagement. This development is critical to understanding the debt trap. Prior to Rothschild's intervention, governments theoretically retained the option to default on their obligations. If a monarch reneged on a debt, their creditors would absorb the loss and the financial system would recalibrate. However, Rothschild rendered sovereign debt a globally tradable commodity. A bond issued by the British government could be held by a French investor, subsequently sold to a German bank, and then utilized as collateral for a loan to an Austrian aristocrat. The intricate web of ownership became so complex that defaulting ceased to be merely a refusal to satisfy a single creditor. It now risked precipitating a systemic collapse of the international financial network. This, then, was Rothschild's seminal innovation to render debt so interconnected that default became practically impossible, not due to governmental integrity, but because such an act would trigger widespread financial devastation. Governments found themselves ensnared, compelled to maintain payments and perpetually borrow to service the interest on their existing debts. The debt trap was no longer merely permanent, it was rendered utterly inescapable. The Rothschild family's wealth reached its zenith in the mid-19th century, positioning them as the wealthiest dynasty globally, surpassing even that of royalty. This immense fortune was derived from a single source: the interest generated from sovereign debt. They produced no tangible goods and constructed no physical assets. Their wealth accrued solely from lending to governments and collecting perpetual interest payments. The system, initially conceived by Patterson in 1694, was subsequently industrialized by Rothschild by 1815, resulting in the entrapment of every European government. By the dawn of the 20th century, the United States was emerging as a formidable economic power, yet its financial system remained comparatively rudimentary. Banks operated independently, the money supply was inextricably linked to gold reserves, and a centralized mechanism for managing debt was absent. J.P. Morgan rectified this situation, not for the broader public good, but to safeguard his own banking empire. In 1907, a financial crisis erupted, characterized by a precipitous decline in stock prices, widespread bank failures, and a general economic paralysis. J.P. Morgan personally orchestrated a rescue operation. He convened the leading New York bankers in his private library, effectively locking them in until they pledged their own capital to stabilize the faltering financial institutions. This intervention proved successful, arresting the panic and establishing Morgan as the de facto central banker of the United States. However, at 70 years of age, Morgan recognized his limitations in repeating such an intervention. Consequently, Morgan and his associates, the most influential financiers in America, devised a permanent solution: the establishment of a central bank. Despite the deep-seated American aversion to central banking, evidenced by the closure of the first and second banks of the United States due to popular opposition, Morgan's group opted for a clandestine approach. In 1910, Morgan's associates, including Senator Nelson Aldrich and representatives from the nation's largest banks, convened a secret gathering on Jekyll Island, Georgia. Over a period of 9 days, they meticulously designed the framework for what would eventually become the Federal Reserve System. The clandestine nature of these meetings was necessitated by the understanding that public knowledge of bankers orchestrating the nation's monetary system would likely incite widespread unrest. Their plan involved a sophisticated act of political manipulation. The proposed institution would not be designated as a central bank, but rather as a Federal Reserve System. It would comprise 12 regional banks rather than a single monolithic entity, and its oversight would be vested in a board of governors appointed by the president, creating an illusion of decentralization, democratic governance, and public control. However, the underlying structure was meticulously crafted to ensure banker dominance. The regional Federal Reserve banks were to be privately owned by their member banks, which in turn would elect the boards of these regional institutions. These boards would then select the members of the Federal Reserve Board. While some governmental appointees would be included, the ultimate control would reside with the bankers. The most critical power, that of money creation and the purchase of government bonds, was strategically allocated to the Federal Reserve Bank of New York, which was under the direct influence of Wall Street's largest banks, including those associated with Morgan. The Federal Reserve Act was subsequently passed by Congress in December 1913, largely due to the lack of comprehension among many representatives regarding the legislation's implications. This act immediately expanded the debt trap, as the government was no longer solely reliant on borrowing from commercial banks, but could now borrow from the Federal Reserve, which possessed the capacity to create money to acquire government bonds. This effectively established an insatiable demand for government debt. The significance of this development lies in the fact that prior to the Federal Reserve, the government's borrowing capacity was limited by the available capital that banks could lend. However, the Federal Reserve could generate funds by purchasing government bonds. The government would issue a bond, and the Federal Reserve would purchase it with newly created money. This money would then be spent by the government, and the debt would be recorded on the Federal Reserve's balance sheet, supported only by the assurance that taxpayers would service it indefinitely. This mechanism facilitates limitless debt, as the Federal Reserve guarantees a perpetual buyer for government bonds, ensuring a constant demand and enabling the government to continue borrowing indefinitely and roll over its debt without cessation. The resulting interest payments are then transferred from taxpayers to the banks that hold ownership in the Federal Reserve System. Morgan died in 1913, the same year the Federal Reserve was established, yet his legacy is the very structure that underpins the current $38 trillion United States debt. Without the Federal Reserve, the government would be incapable of borrowing on such a grand scale, as the market would not sustain it. However, with the Federal Reserve acting as a guaranteed purchaser, the borrowing limit is effectively removed, rendering the debt trap infinite. By the 1970s, the debt trap meticulously constructed by Patterson, Rothschild, and Morgan had become a global phenomenon. Every developed nation engaged in borrowing, rolling over existing debts, and paying interest. Developing nations, however, faced a different reality. They borrowed for infrastructure projects but frequently found themselves incapable of meeting their repayment obligations. The debt trap was approaching its limits until Paul Volcker rendered it permanent. Volcker served as the chairman of the Federal Reserve from 1979 to 1987. He confronted a critical issue: inflation exceeding 10% and a diminishing credibility of the United States on the international stage, with foreign governments beginning to lose confidence in the dollar. Volcker recognized the necessity of curbing inflation, even if it entailed inducing a recession. Consequently, in 1979, he implemented a drastic increase in interest rates. The federal funds rate surged from 11% to a historic high of 20%. This aggressive monetary policy successfully suppressed inflation, but produced a significant secondary effect. Developing nations, having incurred substantial dollar-denominated debts during the 1970s when interest rates were low, now faced the daunting prospect of repaying these loans at significantly elevated rates. Mexico, for instance, owed $80 billion, Brazil $60 billion, and Argentina $40 billion. Their inability to meet these obligations became apparent. The sheer volume of interest payments alone surpassed their export earnings. In August 1982, Mexico declared its inability to meet its financial commitments, signaling a potential default. This event threatened to trigger a global financial collapse, as American banks held a substantial portion of these loans. A default by Mexico would have resulted in catastrophic losses for major institutions like Citibank, Bank of America, and Chase Manhattan, potentially leading to their failure and jeopardizing the entire banking system. Volcker possessed the option to permit this outcome, allowing banks to incur losses and enabling the market to reach a natural equilibrium. However, he opted for a different course of action. He orchestrated a bailout facilitated by the International Monetary Fund, IMF. The IMF would provide Mexico, Brazil, Argentina, and other nations with sufficient funds to continue making interest payments to American banks. These loans were termed structural adjustment loans and were contingent upon the imposition of stringent conditions. These conditions were severe, mandating governments to curtail public spending, privatize state-owned assets, liberalize their markets to foreign investment, and devalue their currencies, effectively surrendering their economic sovereignty in exchange for the capital necessary to maintain interest payments. Crucially, these IMF loans did not reduce the overall debt burden. They merely restructured and perpetuated it, making it manageable but enduring. This constitutes Volcker's innovation. When debt becomes unserviceable, rather than forgiving it, restructure it. Provide sufficient funds to ensure continued interest payments while extracting significant political and economic concessions in return. The debt trap thus transformed into an instrument of control. Nations unable to meet their obligations were compelled to open their economies, divest their assets, and adhere to foreign economic policies, all in exchange for the dubious privilege of remaining indebted. This pattern has been replicated consistently for 40 years, evident in cases such as Greece in 2010, Argentina in 2001, and Sri Lanka in 2022. In each instance, the same framework applies: IMF loans to sustain interest payments, austerity measures imposed, sovereignty surrendered, and the debt never truly eliminated, merely restructured into a perpetual state. Volcker passed away in 2019, but his legacy is the mechanism that ensures the debt trap is both global and inescapable. Even when countries are unable to repay, they are prevented from defaulting. Instead, they are refinanced into a state of perpetual indebtedness, ensuring that interest continues to flow to the creditors. The same banks, institutions, and the very system established by Patterson in 1694. Now let me illustrate how these four architects meticulously constructed a system characterized by infinite debt and insurmountable escape routes. Begin with Patterson's foundational model. A government borrows, commits to perpetual interest payments, and never repays the principal. Introduce Rothschild's refinement, render the debt globally tradable, thereby creating an interconnected web of creditors rather than a singular lender where default risks systemic collapse. Incorporate Morgan's mechanism, establish central banks empowered to create money to purchase government bonds, generating unlimited demand and enabling perpetual government borrowing. Finally, add Volcker's critical element. When nations falter in their payments, restructure the debt instead of forgiving it, ensuring the continued flow of interest. The cumulative outcome of these innovations is the reality we face today: $315 trillion in global debt, encompassing government, corporate, and household obligations. None of this debt is ever intended for repayment. All of it accrues interest, and all of it is interconnected through the financial system, meaning a default in one sector poses a threat of contagion to all others. Consider the specific mechanism within the United States. The government has issued $38 trillion in debt. A significant portion, approximately $20 trillion, is held by the American populace through entities such as pension funds, mutual funds, insurance companies, banks, and the Federal Reserve. These institutions acquire treasury bonds, perceived as secure investments, which yield annual interest payments amounting to approximately $1 trillion. This interest is funded by taxpayer revenue, creating a continuous transfer of wealth from the general population to bondholders, predominantly wealthy institutions, year after year in perpetuity. The remaining $18 trillion is owed by the government to itself, specifically to trust funds like Social Security and Medicare. The government has borrowed from these programs, effectively spending the funds, and now owes the money back. However, ultimately, taxpayers bear this obligation, as the government must raise taxes or borrow further to fulfill its commitments when these trust funds require redemption. This represents a complex financial maneuver, but the interest payments are invariably made. Now let us expand this model to a global scale. Japan owes $9 trillion, primarily to Japanese institutions and the Bank of Japan. Europe's debt stands at $14 trillion, largely held by European banks and the European Central Bank. China carries substantial domestic debt held by its state-owned banks. Every nation operates under a similar system, and all are interconnected. Japan holds United States Treasury bonds, while the US through the IMF holds European debt. Europe via the World Bank holds debt from developing nations. This creates a circular flow of obligations where everyone owes everyone else, and the interest payments funnel upwards to the institutions that manage this debt. Herein lies the fundamental reason for its perpetual nature. If the United States were to eliminate its $38 trillion debt, the nation's money supply would contract dramatically. This is because dollars are created through government borrowing. The cessation of borrowing would lead to the disappearance of these dollars, triggering deflation, economic depression, and widespread collapse. Consequently, the government is constitutionally incapable of eradicating its debt. It must continue to borrow, roll over its obligations, and service the interest. This principle holds true on a global scale. If every government were to repay its debt, the global money supply would shrink by 2/3, leaving insufficient funds to conduct trade and causing the system to grind to a halt. Therefore, debt cannot be eliminated. It is an integral, structurally necessary component by design. And who reaps the benefits from this arrangement? The institutions that hold this debt, such as BlackRock, Vanguard, State Street, and Fidelity. These asset management firms control trillions of dollars. They invest the funds of others, from pension accounts, retirement savings, and insurance premiums, into government bonds, collecting vast sums in interest. The interest paid on U.S. debt alone amounts to approximately $1 trillion annually, in addition to interest from Japan, Europe, and all other nations. This annual inflow of interest payments, representing a transfer from taxpayers to bondholders, constitutes the largest wealth transfer in history. It is a continuous, structural, and largely imperceptible process for the majority of the populace, as it is not formally categorized as a tax but rather as debt service. Nevertheless, the underlying mechanism is identical. Workers contribute, institutions profit, and the debt never diminishes. The four architects did not collude. They lived in different eras. However, each independently devised solutions that primarily benefited bankers, with each subsequent innovation building upon the preceding one. Patterson established permanent debt in 1694. Rothschild globalized it in 1815. Morgan made it infinite in 1913. In 1982, Volcker cemented its permanence. They jointly established a framework enabling governments to perpetually incur debt, with interest payments continuing indefinitely. Consequently, those who oversee the bonds, manage the liabilities, and receive the accrued interest emerge as the primary beneficiaries. This advantage accrues not to the governments or the taxpayers, but to the financial entities. And here lies the ultimate revelation. For these institutions, $38 trillion does not represent a crisis, but rather a functional business strategy. Each unit of outstanding debt constitutes an asset on someone's ledger, generating interest income and serving as security for further financial commitments. As long as faith persists and the populace remains convinced that governmental entities will honor their interest obligations, even without ever retiring the principal, the mechanism continues to operate. The cycle of indebtedness is thus fully realized, rendering escape infeasible without triggering a systemic financial collapse. Four masterminds, spanning 300 years, conceived a single enduring system, and every individual on the planet is now ensnared within its reach. If this perspective has reshaped your understanding of governmental indebtedness, if you now grasp that the sum of $38 trillion is not the result of chance or error, but a meticulously constructed system functioning precisely as intended, then you are beginning to comprehend the true nature of power. Subscribe if you seek to unravel the construction of this apparatus and identify its operators, for such knowledge will not be imparted within educational institutions. Instead, you will be instructed that debt is an issue requiring resolution. However, the original designers recognized a more profound truth. Debt is not a problem, but rather the very bedrock upon which their system is founded, and interest is the levy collected for permission to inhabit their creation.